Hi, this is a reading for people who are blind or print disabled from the Audible Local Ledger. This is Barron's for March 8th of 2025. My name's Eric. We'll start with up and down Wall Street. Trump's global paradigm shift is bad news for U.S. stocks. This is by Randall W. Forsyth. In a matter of a few chaotic weeks, President Donald Trump has begun to fashion a new world economic order. What it will ultimately mean for investors isn't clear. The forces driving the equity, bond, currency, and commodity markets will change in ways that can't yet be predicted. So far, the main effect has been a $3 trillion reduction in the value of U.S. stocks since Trump's January 20th inauguration. The only rational response for investors is to stay liquid and agile, as the changes will continue to be fast and furious. While the headlines have centered on a blizzard of announcements of tariffs and terminations of federal employees and their suspensions or reversals, Trump also has forced fundamental changes in policies abroad. These will begin to alter America's basic trading relationships with other countries, which will emphasize domestic spending over trade as the main driver of their economies. Also, Europe will shoulder a greater amount of the burden for its own defense. Germany announced this past week a major expansion of military and infrastructure expenditures, in the process throwing off its previous restraints on borrowing and military spending. It'll spend in future years about as much as it did on the former East Germany after unification of the former communist state, according to the Deutsche Bank economist Robin Winkler. This was characterized by Treasury Secretary Scott Bessent as an early big win for President Trump's bold international agenda, quote unquote. In a speech to the Economic Club of New York on Thursday, Bessent placed it in the context of a rearrangement of an unconstrained trade misalignment. To understand this better, it's worthwhile to review the critique of the global trading and financial system by Stephen Moran, Trump's nominee to head the Council of Economic Advisers, discussed previously in this space. The U.S., by virtue of being the issuer of the dollar, the world's primary currency for reserves, trade, and finance, runs a consistent deficit on its external account. To supply the global economy with the greenbacks it needs, the U.S. imports more than it exports. That allows Americans to spend more than they earn and to save less than they invest. Much of that negative saving is represented by the federal budget deficit, which is largely covered by foreign capital. To be sure, the attributes of the greenback aren't the only reason global capital comes to the U.S. American exceptionalism is exemplified by the Magnificent Seven megacap technology stocks, and diversifying portfolios outside the U.S. has penalized investors. Also, the U.S. remains a top destination for the world's wealthy, whom Trump now courts with a $5 million gold card. The flip side of the dollar's attraction was a persistent trade deficit. Imports were made cheaper for U.S. consumers while disadvantaging U.S. exporters. Beyond comparative advantage models in elementary economic textbooks, other nations exploited the system to drive their economies with exports. The U.S. became the consumer of first and last resort, resulting in the loss of many industries and living standards for many Americans, a major force that twice elected Trump. Reorienting Europe's largest economy away from dependence on exports and toward domestic demand has been dubbed a whatever-it-takes declaration by that nation's likely new leader, Friedrich Merz, recalling former European Central Bank President Mario Draghi's identical declaration during the European financial crisis in the past decade. That Berlin would throw off former limits on military spending after Trump's Oval Office confrontation with Ukrainian President Vladimir Zelensky on February 28th also seems no coincidence. European leaders no longer believe the U.S. will provide military and economic security for them, following the tariff threats and Trump's withdrawal of support for Ukraine, according to a client note from a Strategas policy research team led by Dan Clifton. The net effect is the U.S. passing the baton of fiscal spending to non-U.S. countries, it states. According to an analysis by Chris March of Exante Data, the U.S. has had to devote 3.5% of gross domestic product to defense, which in part reflects having to defend two fronts in the Western Hemisphere and the Pacific. North Atlantic Treaty Organization members devoted an aggregate 2.5% of GDP. For most of the past decade, Europe and Canada spent about 1.5%. To compensate for past underspending on defense and infrastructure, Germany will boost spending by about 2 to 3% annually for the next decade. Germany's fiscal adjustment has had major financial repercussions. The benchmark 10-year Bund yield jumped 30 basis points. That's 0.3 of a percentage point on Wednesday. That's the biggest single-day increase since 1997. In price terms, it was equivalent to a 1,000-plus point drop in the Dow Jones Industrial Average for what's typically described as a risk-free security. The jump in German bond yields reflects the higher real growth and increased borrowing prospects resulting from the country's fiscal U-turn. To a lesser extent, China also announced this past week increased fiscal spending in a bid to spur domestic spending and stave off the persistent deflation from its real estate decline. Beijing's main tactic has been to use trade to offset domestic weakness, with exports accounting in 2024 for the highest percentage of GDP in 18 years, other than in COVID-affected 2020, according to a research note by Rory Green of T.S. Lombard. While the package coming from the National People's Congress this past week merely confirmed a GDP growth target of about 5%, quote-unquote, achieving that would require a significant boost to domestic demand. Given the additional 10% tariffs on exports to the U.S. that's been set by Trump, trade can't be counted on for growth. To achieve that 2025 target would require consumption and investment to surge 43%, Green writes. China President Xi Jinping wants growth, which has contributed to the strong rally in Chinese equities, Green adds. The iShares China Large Cap Exchange Traded Fund, ticker FXI, is up 29% since early January. The Communist Party is worried about stocks and property values, so Green sees Beijing installing various puts to support these markets. The key is raising income and confidence, he writes in the report, which includes a chart of the rising number of protest events in China. Economics is a national and social security issue for Beijing, he points out. While Trump continues to announce tariffs only to pause them, sometimes within just hours, Lori Calvasina, RBC Capital Markets head of U.S. equity strategy, writes in a client note that investors who continue to insist that tariffs are merely a negotiating tactic with a very low chance of becoming a long-lasting reality simply haven't been listening to what the administration has been saying, or are having a hard time understanding that a paradigm shift is underway. As for the presumption that there's a Trump put underneath the stock market, she adds that Bessent's comment on Thursday's ECNY presentation that Wall Street's done great, Wall Street can continue doing well, but this administration is about Main Street, indicated to us that keeping equity investors happy may not be the administration's top priority right now. Instead, the Treasury Secretary pointed to the administration's targeting of the 10-year yield, to which mortgage interest rates are hitched. The benchmark Treasury yield has declined to 4.25% from 4.58% before Trump's inauguration. But that mainly reflects the flight from risk, as U.S. stock market wealth has shrunk by over $3 trillion over that span. Investors should recognize the current priorities. Given the uncertainty about policies, which change almost by the hour in Washington now and may be equally unpredictable elsewhere, making absolute pronouncements about investment portfolios seems foolish. Even Trump warned of a little disturbance in his speech to Congress this past week as stocks headed for their worst week since September. Bessent warned on Friday in a CNBC interview that the economy is headed for a detox period. The highest conviction trades coming into 2025 buy U.S. exceptionalism in the Mag 7, avoid the rest of the world, sell bonds, have been turned on their head. Chinese and German stocks are up by double digits since January 20th, while the U.S., and notably information tech and consumer discretionary stocks, is down since then. John Higgins, Capital Economics chief markets economist, is sticking with his year-end S&P 500 target of 7,000, reflecting a gain of more than 30% from here and outpacing both China and Germany for 2025. The artificial intelligence trade isn't dead, notwithstanding the DeepSeek news, and the U.S. economy should hold firm, he wrote in a client note on Friday. And while the interest rate futures market predicts 3 cuts by the Federal Reserve by year-end, Higgins sees the 10-year Treasury yield rebounding to 4.75%, reversing the price rally in bonds that was seen this year. Technically, the S&P 500 hovers around its key 200-day moving average at about 5,700. Evercore, ISI's equity and derivative strategists, led by Julian Emanuel, wrote in a note on Friday. This coming week will be a huge test of Trump's attitude toward the market, with 25% tariffs on steel and aluminum to hit March 12th, followed by a possible government shutdown March 14th. Diversification among asset classes and markets with a healthy stash of cash ready to deploy seems a cop-out, but the least risky tack. After all the head-snapping headlines on tariffs, trade, and geopolitics, the Federal Employment Report released on Friday morning was anticlimactic. While the non-farm payrolls 151,000 gain was close to economists' consensus guess, the separate series on households was a bit soft. The headline jobless rate ticked up 0.1 of a percentage point to 4.1%, while the so-called underemployment rate jumped a half point to 8%, largely because of more people working part-time when they would have preferred full-time gigs. Still, Fed Chair Jerome Powell reiterated Friday that monetary policymakers could continue to be patient with interest rate cuts. While no move is likely at their March 18th and 19th confab, they'll present a new summary of economic projections, which will include their guesses about the year-end federal funds target. Who knows what could happen by then? Moving on to the Streetwise column, written by Jack Huff. Is the S&P 500 enough? Clues from 125 years of returns. Let's not call this a crisis of confidence in the S&P 500 index. At most, it's a hiccup amid hallelujahs. The index was recently down slightly year-to-date, but has still more than tripled investor money over the past decade. There are anxieties for those who know where to look for them, however. Defensive sectors are rallying. Is that a change in leadership? Healthcare, one of last year's worst performers, is this year's best. Value stocks outperformed growth by 3.9 percentage points in February, one of the top 5% of months for relative value returns going back to 1979, according to BofA Securities. Meanwhile, shares in Europe and China are outperforming the U.S. this year. All of this will leave indexers torn over whether to fiddle with their fund mixes. 3 United Kingdom professors released a report that doesn't address this topic directly but offers clues to how investors should think about long-term returns. Paul Marsh and Mike Staunton at London Business School and Elroy Dimson at Cambridge University compiled evidence on the exploits of stocks, bonds, bills, currencies, and consumer prices across countries and time periods, including ones that Wall Street doesn't typically include in its glossy brochures. The 3 presented their findings in a book near the turn of the millennium called Triumph of the Optimists, 101 Years of Global Investment Returns, and have since offered yearly updates with the latest, sponsored by Swiss bank UBS, including 125 years of data. Here are some observations that stand out. America has gone from exceptional to exceptionaler. In 2000, the U.S. had been the best performing stock market of the prior century, swelling from 14% of the world market to 49%. Since then, U.S. dominance hasn't just continued, but also grown, reaching 64% of the world's stock market value last year and 73% of developed markets. Dominant markets don't have to lose their place to slip into underperformance. All that's needed is for the good news to be fully reflected in stock prices. But there have also been stark changes. The UK is 3% of world stock markets, down from a leading 24% in 1900, and it isn't the most extreme example. Yes, I'm talking about the 1986 film starring Michael Keaton. Gung Ho isn't a business comedy, it's an investment horror prequel. A Tokyo automaker attempts efficiency improvements at a Pennsylvania plant. Hilarity ensues, or doesn't, judging by a 33% positive rating at RottenTomatoes.com. The plot, though, reflected the angst that Americans felt at the time over ceding their corporate dominance to Japan, which rose to 40% of the world's stock market by 1989 versus the U.S. at 29%. Turns out that was just a giant asset bubble. Japan today is down below 6%. Time to buy? Maybe, but international diversification has worked, except for Americans. Putting money overseas wasn't a thing for most U.S. investors until a 1974 paper on the subject argued that doing so could reduce risk by half. Money soon trickled, then flowed, then flooded into international funds. Investors in most countries got the promised benefits. But for risk-adjusted returns, American investors would have been better off staying home. This is true whether they started at the time of that paper 50 years ago or in 1980, 90, or 2000. The U.S. stock market has outperformed, and non-U.S. markets have exhibited higher volatility. Bonds stink, but you probably need them. The average real or after-inflation return on government bonds since 1900 was just 0.9% a year, and they aren't as safe as you might assume. Volatility of returns has been lower for bonds than stocks, and stocks have seen worse crashes, but bonds have experienced much longer periods to break even. Investors who bought stocks at the peak before the Great Depression needed more than 15 years to get back to their starting point adjusted for inflation. But those who bought bonds at their 1940 peak need more than 50 years. The real reason to buy bonds is that correlation between them and stocks are low. In other words, buy some bonds. They'll probably stink long term, but you'll be happy to have them during rough rides for stocks. Stocks are great, just not most of them. U.S. stocks returned an annualized 9.7% over the past century and a quarter, or 6.6% after inflation. That was enough to turn $1 into $2,911 of buying power. Even if you bought stocks everywhere but the U.S., you've made an annualized 4.3% and turned $1 into $194. Not bad for an epic misstep. In fact, stocks were the best performing asset class for all 21 countries with continuous 125-year investment histories. But most individual stocks aren't great or even good. The professors point to a 2018 study showing that 57% of U.S. stocks had lifetime returns that were worse than Treasury bills. The net gain for the U.S. stock market over the past century is explained by just 4% of its stocks. That's the real reason to hold a big basket of stocks like an index fund. If you own an S&P 500 fund, you've been increasingly bullish on Nvidia since 2001. Congratulations on your foresight. The U.S. stock market looks concentrated, or maybe not. 3 companies recently made up 19% of the market. Concentration is the highest in 92 years. Something has to give. Or does it? The market was more concentrated in 1900. It was 63% railroads. Somehow stocks have done well since then, even though railroads are now less than 1%. And have you seen the concentration elsewhere? In France, 3 stocks are 23% of the market. In Germany, 36%. Korea, 40%, and Taiwan 59%. Among the world's dozen largest markets, the U.S. is the third least concentrated behind Japan and India. Returns look stingier, but still okay. U.S. stocks have returned a real 4.9% a year over the past quarter century, versus 7% over the prior century. The professors predict lifetime returns by generation, and no one is matching the baby boomers. Generation Z can expect a real 3.9% a year on 60-40 portfolios of stocks and bonds. Worse than other generations, including a point less than millennials, but hardly grim. Moving into the review and preview section for the March 10th edition of Barron's, The Missing Billionaires, which is reported by Abby Schultz. There's something curious about the Chronicle of Philanthropy's well-regarded list of the 50 most generous American donors. Some of the wealthiest people aren't on it. In fact, only 19 of the richest people in the country, as measured by the Forbes list of the 400 richest people in America, show up on the Chronicle's latest ranking of the 50 biggest donors. Those 19 gave more than 3/4 of the $16.2 billion that was donated by the top 50 last year. Where are all the other billionaires? Are they perhaps a tad stingy? Well, not necessarily. They may simply be keeping quiet about their giving. Nobody has to say what they're giving to charity unless they report it to us, says Maria Demento, who heads up research for the list. Consider Mackenzie Scott, whose website Yield Giving says she's donated more than $19.25 billion to charity since 2020. But Scott and her reps won't disclose to the Chronicle how much she donates in a given year, Demento says. Michael Bloomberg landed the top spot for the second year in a row. He gave away $3.7 billion, including $1 billion to his alma mater, Johns Hopkins University. Among newcomers, Ruth Gottesman, number 6, with a $1 billion gift of free tuition to students of the Albert Einstein College of Medicine in New York, where she is a professor emerita. The gift came from the fortune earned by her husband David, a protege of number 4 ranked Warren Buffett. Last week, in the markets, President Donald Trump named 5 digital assets for a crypto reserve, but said no government money would be used to fund it. He levied tariffs on China, Canada, and Mexico, noting in a speech to Congress that they would cause a little disturbance. A day later, with stocks selling off and the Atlanta Fed's GDP now forecasting a 2.8% first quarter contraction, he paused Mexico and Canadian auto tariffs and then exempted most tariffs on the two until April 2nd. Stocks fell further and then bounced on solid jobs numbers. On the week, the Dow Industrials fell 2.4%, the S&P 500 3.1%, and the Nasdaq Composite 3.5%. In companies last week, China retaliated against U.S. tariffs with 10 to 15% levies on farm goods and banned imports of genetic sequencers. Canada pulled back its retaliatory tariffs. The administration said it would sell 443 federal properties, and then they cut the list to 330, and then they took it down completely. DOGE told the top 10 federal consultants they had a day to justify their contracts. The largest, Deloitte, with $1.9 billion for IRS IT services. SpaceX's Starship rocket blew up 8 minutes after launch. In deals, a BlackRock-led investor group bought 80% of Hong Kong-based CK Hutchison's port business for $23 billion, including 2 Panama Canal ports. Japan's 7&I Holdings plans to list its 7-Eleven business in the U.S. and buy back $13 billion in shares to fight a takeover from Alimentation Couche-Tard. Sycamore Partners agreed to buy Walgreens Boots Alliance for $10 billion. And this week, today, Monday, March 10th, two mega-cap software companies highlight a very quiet week on the earnings calendar. Oracle reports quarterly results Monday and Adobe on Wednesday. On Wednesday, March 12th of this week, the Bureau of Labor Statistics releases the Consumer Price Index for February. Economists forecast a 2.9% year-over-year increase. The core CPI, which strips out food and energy prices, is expected to rise 3.2%. Both estimates would be 0.1 of a percentage less than the January figures. The annual change in the score CPI has been stuck in a narrow range of 3.2 to 3.3% since last summer. On Friday, March 14th, the University of Michigan releases its Consumer Sentiment Index for March. Consensus estimate is for a 63.9 reading. That's slightly less than in February. Plummeting consumer confidence and rising inflation expectations roiled the stock market over the past month. The most recent reading from the University of Michigan was a 15-month low, while a similar survey in late February from the Conference Board registered the largest monthly decline since August of 2021. Consumers' expectations of the year-ahead inflation was 4.3% in February in the Michigan survey, and that was the highest reading since late 2023. By the numbers, $540 billion. That's the volume of Chinese exports in the first 2 months, which is a record. Imports fell 8.4% for a record trade surplus. $12 trillion. The estimate of new government debt globally in 2025, which is a record. Total debt would hit $77 trillion, also a record. 2.1 billion. That's the number of adults globally who are overweight or obese, more than doubling over the past 30 years. 36%. That's the percentage of U.S. workers who plan to retire at 70 or later. Some 53% say they'll work in retirement. The next story, how Trump's policies could raise home prices. Tariffs and deportations threaten to make housing more expensive, pushing home ownership out of reach for millions. By Shaina Mishkin. Donald Trump campaigned on bringing down the cost of living, including house prices, but his administration is embracing policies that probably will make housing more expensive. Putting tariffs on Canadian lumber and drywall from Mexico and imported appliances raise home prices, and deporting millions of undocumented workers will hamstring a construction industry where just under a quarter of workers are undocumented immigrants, said the left-leaning Center for American Progress. Anything that pushes the price of a home or build costs higher is going to be net detrimental for home buyers right now, says Rick Palacios, Jr. of real estate research firm John Burns Research and Consulting. They're having a tough time as it is. The new Trump policies come at a precarious time for the housing industry. Home prices hover at record levels, largely because construction has failed to keep up with demand. The combination of high home prices and high mortgage rates has pushed home ownership out of reach for millions of Americans. There are a few reasons to think the picture for buyers will dramatically improve this year. The spring selling season will be very challenging if we don't see some relief on rates, says Ivy Zellman, Executive Vice President of housing research firm Zellman & Associates. Mortgage rates have fallen to a recent 6.76%, but they still remain high. To be sure, Trump's drive to cut regulations and lower interest rates could spur both home building and housing demand. The president directed agencies to lower the cost of housing and increase the supply of homes in an executive order decrying the burden that regulatory requirements add to the costs. Treasury Secretary Scott Bessent's focus on lowering long-term yields could also be a boon for buyers. The U.S. housing crisis is a supply and demand problem. It would take 3 or more years of home building at current rates to meet the need for 3.7 million units, estimates Freddie Mac Deputy Chief Economist Len Kiefer. The country's built an average of only 1 million single-family homes over the past 5 years, a trend forecasters expect to continue in 2025. The only way that we're going to solve high home prices is to put more supply on the market, says Jim Tobin, CEO of the National Association of Home Builders, or NAHB, noting that both presidential candidates ran on improving housing affordability. Some of the actions we've seen after that are maybe running counter to that. Inflation hit every part of the economy in the wake of the COVID-19 pandemic, and home materials were whacked particularly hard. The cost of construction materials is up more than 30% since the pandemic began, according to the NAHB. As lockdowns snarled supply chains, builders faced significant shortages of nearly everything from windows and doors to home appliances, right when buyer demand was reaching its zenith. It could get worse. New tariffs, including those on Canada and Mexico, complicate home building supply chains, and ultimately it drives up costs for buyers, the industry warns. The cost of building is now just going to go up and is ultimately going to be borne by the home buyer or renter, says the NAHB's Tobin. Tariffs on Canada and Mexico, which produce lumber and the gypsum used in drywall, are of concern, as are appliances from China. The president announced the tariffs in early February before postponing enforcement of those on Canada and Mexico. An indication of future construction, the NAHB's Sentiment Index dropped in February by 5 points, its greatest decline since last May. Uncertainty over the scale and scope of tariffs has builders further concerned about costs, says Robert Dietz, the trade group's chief economist. There's now more concern around deportation risk, says Zellman, the housing researcher. A quarter of home builder respondents to the firm's January survey said that the fear of immigration service raids resulted in higher levels of absenteeism among subcontractors, with the greatest impacts felt in Baton Rouge, Louisiana, Chicago, Bakersfield, California, San Antonio, and Austin, Texas, Greensboro, North Carolina, and Myrtle Beach, South Carolina. Risks exist outside of home supply. Fannie Mae and Freddie Mac, the two mortgage market giants that buy, securitize, and guarantee loans from lenders, have been under government conservatorship since the 2008 and 9 financial crisis. The first Trump administration sought to remove the companies from conservatorship, but stopped short. If the mortgage giants ultimately lose their implied government guarantees, mortgage rates would probably climb. Our housing finance system, while it's probably not how you would have drawn it up on a whiteboard from scratch, is the envy of the world, says Bob Brooksmith, the CEO of the Mortgage Bankers Association. Any responsible exit would be accompanied by a legislated explicit guarantee on the mortgage-backed securities of Fannie and Freddie so as not to jeopardize that system. How and whether the administration releases the company from conservatorship has yet to be seen. Bill Pulte, Trump's nominee to lead the Federal Housing Finance Agency, which regulates Fannie and Freddie, noted the risks at his confirmation hearing in February. While their conservatorship should not be indefinite, any exit from conservatorship must be carefully planned to ensure the safety and soundness of the housing market without upward pressure on mortgage rates, said Pulte, whose grandfather started home builder Pulte Group, of which Bill Pulte is a former director. Home purchases have already slowed because of high prices and a lack of resale inventory. Builders have been offering incentives to lure buyers, and investors are souring on the sector. The iShares U.S. Home Construction Exchange Traded Fund is down about 6.1% so far this year, compared with the S&P 500's index's 1.9% loss. The worry in the stocks is that margins are going to compress, says BTIG analyst Carl Reichart. The headwinds could weigh on new home construction for months or even years. That could push up prices further. Anything that makes home prices increase more than they would otherwise is concerning, says Brooksmith of the Mortgage Bankers Association. We don't want a generation that's given up on home ownership. Our next headline in the Barron's dated March 10th of 2025. These stocks can fight through the trade war. How to cope with tariff uncertainties? Focus on selecting strong, domestically oriented stocks or those that benefit from trade turmoil, by Paul R. LaMonica. President Donald Trump's whipsawing tariffs are roiling markets. Instead of worrying incessantly about a trade war, consider some alternatives. Invest in companies with growth drivers intact or ways to benefit from trade turmoil. If you expect additional tariffs and disruption, the kind of companies that tend to benefit are domestically oriented, says Quy Nguyen, Chief Investment Officer of Equity Strategies at Research Affiliates. Look for ones that have a moat where they can pass on costs to consumers. Nguyen likes organic grocery chain Sprouts Farmers Group and apparel retailer Gap. Sprouts has pricing power, she notes, and its emphasis on locally produced food should help shield sales if tariffs on products from Canada and Mexico go into effect. Wall Street expects Sprouts' profits to rise 22% this year and 13.5% in 2026. Its stock is up 6% this year. Gap, a recent Barron's stock pick, would take some hits from Trump's tariffs on China, now at 20%, but Chinese shopping apps Shein and Temu may fare worse, allowing Gap to pick up sales, Nguyen says. Gap stock soared 19% on Friday after the company topped Wall Street estimates, but the price still isn't demanding, at 10 times 2025 estimates with a 2.9% dividend yield. Greg Halter, Director of Research at Carnegie Investment Counsel, is sticking with quality growth companies in real estate, financials, and healthcare. One real estate investment trust, or REIT, he likes is Public Storage, which rents self-service storage. Its facilities are 92% occupied, and the company's finding ways to cut costs, switching more customers to digital services, and installing solar panels to curb electricity costs. Analysts don't see much profit growth this year, but expect operating income to rise 4% in 2026, with ample coverage for the REIT to maintain or hike its dividend, which yields 3.9%. Halter also owns American Tower, a cellular infrastructure firm that should benefit from rising data traffic due to increased uses of wireless devices and artificial intelligence. Wall Street is forecasting earnings growth of 13% annually on average for the next few years. The stock is bucking the tariff malaise, up about 13% so far this year. Financial services stocks have been hit by concerns that tariffs will slow economic growth and capital markets activity, like financing debt and equity deals. The Financial Select Sector SPDR exchange-traded fund is down 5% in the past month. Nguyen thinks concerns are overblown. Banks are cheap, she says, and Trump's push for deregulation could lead to a rebound in merger activity and initial public offerings. Funds using strategies from research affiliates own Citigroup and Wells Fargo shares, which trade for 9 and 12 times 2025 earnings estimates, respectively. Profits this year are expected to soar more than 20% at Citigroup and 6% for Wells Fargo. Halter likes Progressive, a property and casualty insurer that's been gaining market share in automobile insurance. It's expected to generate annual earnings increases of 15% on average for the next few years. He also owns Chubb, a commercial property and casualty firm that's a top holding of Berkshire Hathaway. Chubb is expected to benefit from easing insurance loss ratios over the next few years following a spike due to the recent California wildfires. Both stocks have a domestic focus, and they trade at price-to-earnings ratios below the S&P 500 index's multiple of about 19. Healthcare stocks have been a recent winner as investors seek alternatives to high-price growth stocks. Two standouts, says Halter, are medical technology company Stryker and hospital services company Steris. Both have scant tariff exposure. They're also in healthcare sectors and aren't likely to face as much scrutiny from Health and Human Services Secretary Robert Kennedy Jr. as drug makers and biotechs. Neither's cheap at about 25 times earnings, but both are expected to report profit increases of more than 10% this year. CVS Health may be finally mounting a comeback. It's up 45% this year on the back of stronger earnings. Dan Genter, CEO and Chief Investment Officer of Genter Capital Management, favors the stock partly because he thinks it'll be taboo for Trump to do anything with tariffs that raise the already steep costs of drugs and other medical care. Shares are still cheap at 11 times 2025 profit estimates with a 4% yield. Genter also likes Medtronic, which is seeing steady demand for its insulin delivery pumps and heart monitoring devices. Medtronic, up about 16% this year, trades at 16 times 2025 estimates and yields 3%. Some fund managers are trying to play tariff offense, looking for trade war winners. There are companies that will benefit from tariffs, says Jake Schermeyer, portfolio manager at Harbor Capital Advisors. Miner Freeport-McMoRan, for instance, has a copper mining operation in Arizona that could get a boost from potential tariffs on copper imports. The stock trades for 22 times earnings estimates and could rally further if copper prices, up nearly 20% this year, continue to climb. Schermeyer also likes First Solar, a U.S.-based solar manufacturer that should benefit from higher duties on imported panels. The company, which manufactures in the U.S. and India, recently announced plans to reduce production in Malaysia and Vietnam, attributing the decision in part to the U.S. policy environment. First Solar is cheap at 7 times forward earnings estimates, even if profits take a haircut. That provides a wide margin of safety. Wall Street's consensus target price of $245 is nearly 90% above current levels. Solar, of course, is on the wrong side of Trump's fossil fuel-oriented energy policy, but tariffs on imported panels would help it maintain pricing. Its customers are utilities and industrial companies that are still ordering panels to meet growing electricity demand. For contrarian investors, that may make First Solar a ray of light amid the dark days of Trump's trade war. Our next headline: Hims stock is due for a crash diet. Telehealth firm Hims & Hers spent millions ramping up its weight loss business. Now it's losing access to its best drug. By Josh Nathan Kazis. The rapid rise of GLP-1 weight loss drugs has come with a raucous sideshow, a wave of copycat drugs unbound by drug patents. The knockoff surge was led by Hims & Hers Health, the telehealth firm that began selling the drugs last spring. Cheap, compounded versions of the weight loss drugs have been a cottage industry for a few years, but it was the arrival of Hims, a multi-billion-dollar public company, that brought the knockoff medicines into the mainstream. Hims stock soared in the months that followed, while the GLP-1 patent holders Eli Lilly and Novo Nordisk saw their stocks come under significant pressure. Now the whole shakeup is coming to an end, even quicker than it began, and Hims shareholders could be left in an unhealthy state. U.S. drug laws allowed compounding pharmacies to manufacture semaglutide and tirzepatide, the GLP-1 drugs sold by Novo Nordisk and Eli Lilly, as long as they were considered to be in shortage. The FDA recently declared an end to the shortages, though, which means the compounding pharmacies need to stop making the drugs in bulk. The abrupt end to the copycat business isn't a surprise. The GLP-1 shortages were always bound to end. But in the interim, Hims & Hers spent untold millions ramping up its weight loss business, mounting a marketing blitz that culminated with a minute-long Super Bowl ad in February. Now that the products are on their way out, Hims & Hers faces a dilemma, justifying a stock price that soared on the massive opportunity in weight loss. Shares peaked near $73 in February. Today, Hims stock is trading around $36 with a market value of roughly $8 billion. Before the company's pivot to weight loss, shares of Hims traded around $15 for a market value of $3.1 billion. Without the ability to sell compounded semaglutide in bulk, those $5 billion in market value gains are at risk as the company's forced to look elsewhere for growth, including older weight loss treatments. Hims says it still expects overall weight loss sales of at least $725 million in 2025, or 30% of its overall projected revenue. The company wouldn't say what that same figure was in 2024. What it has said is that GLP-1 sales were $225 million last year. Most of that amount seems likely to go away in 2025 with the shortages ending. Hims executives had repeatedly said the company would sell personalized doses of GLP-1 drugs to a large number of patients after the shortages ended, an exception that is allowed under laws that regulate compounding. In late February, though, Hims and Hers seemed to describe that opportunity as far smaller. Personalized semaglutide dosages will supplement these core offerings for the subset of consumers for whom it's a clinical necessity, Chief Financial Officer Yemi Okupe said on the company's February 24th earnings call. Shares fell 22.3% the following day. A Hims spokesperson didn't directly address questions about the change in strategy, instead directing Barron's to a post from CEO Andrew Dudum about the company's opportunity in personalized medicine. On the call, Okupe said Hims' steady-state weight loss offering would be primarily composed of generic weight loss pills, not GLP-1 medicines, along with a generic version of an older GLP-1 injection called liraglutide, which it hopes to launch later this year. In other words, the company plans to accelerate weight loss sales with less effective drugs. That could prove challenging. A company spokesperson told Barron's that continued difficulty in getting GLP-1 drugs could make Hims treatments necessary for some patients. Beyond that, Okupe has said Hims weight loss consumers value the benefits the platform brings beyond the medication. Hims is playing the long game. Our capabilities allow us to be a leader today, while ongoing investments will position us to serve millions more Americans once semaglutide is off patent in the coming years, the spokesperson said. Novo Nordisk expects its Wegovy patent to expire in 2032. Hims has reason to stay focused on weight loss. It spent heavily on the opportunity. Hims' marketing costs were up sharply in 2024 to $678.8 million from $446.6 million, while its total operating expenses climbed nearly 50% to $1.1 billion. The company also bought an FDA-regulated compounding pharmacy called Medisource RX for an undisclosed sum. Lilly and Novo, meanwhile, are targeting the weight loss customers that used Hims and other telehealth firms. In new ads, Lilly and Novo call out compounded treatments as unproven. This past week, Novo also launched a new website selling Wegovy directly to cash-paying customers for well below the drug's list price. Lilly has a similar offer for Zepbound. Meanwhile, insurance coverage for both drugs is expanding, further reducing the out-of-pocket cost for many patients. Aside from the GLP-1 mess, Hims' core business selling generic treatments for hair loss, erectile dysfunction, and other conditions looks healthy. Excluding GLP-1 sales, its revenue was up 43% in 2024 to $1.2 billion. The semaglutide surge has likely grown Hims' brand recognition. But at Friday's close of $35.95 a share, investors are pricing in much more than the core business. Wall Street expects Hims to grow earnings 9% this year to 58 cents a share, according to FactSet, giving the stock a price-to-earnings ratio of 62 times. It's a pricey bet, built on very optimistic scenarios. If the weight loss business slows, Hims investors could be left with a much slimmer stock. Our next headline in the Barron's dated March 10th. Private equity wants a piece of your 401k. Companies like Apollo and KKR are angling for retirement savers with new funds. Investors in 401ks should be wary, by Ian Salisbury. America's retirement accounts are a $12 trillion pie, and private equity wants its slice. Seeking new investment amid a global slowdown in fundraising, the industry is looking beyond its traditional world of wealthy individuals and institutional funds. The firms see a vast pool of potential fund investors in 401ks and other retirement accounts that are owned by 70 million Americans through their workplaces. Whether investors would fare better with some private equity in their portfolio versus a traditional stock and bond mix remains debatable, and the industry faces steep roadblocks. But firms are now launching funds and similar investment products for 401ks, and they're betting on more accommodative rules or a pass from the Trump administration to help pave the way. There's no shortage of opportunities in retirement, and we truly haven't even gotten started, said Apollo Global Management CEO Mark Rowan at the company's Investor Day last September. Apollo, which manages more than $750 billion, is getting some of its investments into collective investment trusts, or CITs, which are alternatives to mutual funds for 401ks. One example is the Alta privately managed Alts Fund, launched by Texas firm LeafHouse last year, which holds private investments through Apollo's Aligned Alternatives CIT. KKR, managing $638 billion in assets, is making inroads. The firm last October partnered with Capital Group to launch interval funds with private investments in 2025. These funds have restrictions on when you can sell, hence the name interval, and they're typically marketed to wealthy investors. But Capital Group could get them into 401k plans, building on its foothold in the space with its American funds. Capital Group declined to comment on its plans. The fund industry will still need regulatory and legal cover. The first Trump administration gave a green light for target date funds in 401ks to invest 5 to 10% of assets in private equity, credit, and other alternatives. But alternatives remain largely on the outskirts of most plans, partly because companies and trustees that oversee retirement plans worry about being sued for breaches of fiduciary duty if they delve much beyond stocks and bonds. Plan sponsors are notoriously adverse to risk and cost, said Fred Reich, a prominent Employee Retirement Income Security Act, or ERISA, attorney. Companies are working out ways to create private investment funds with daily liquidity, he points out, and if a private equity investment is to be seen as riskier than a vanilla mutual fund or is more expensive, it will face headwinds. Some investment firms say the doors are starting to crack open. We're seeing a ton of momentum, says Dan Cahill, head of U.S. Defined Contribution at Partners Group, a $152 billion private equity firm. The firm has a beachhead in 401k through its Partners Group Defined Contribution Fund, an investment trust with about 70% of its assets in private markets, 25% in listed private equity, and 5% in cash. Partners is now teaming up with BlackRock to launch portfolios that include private equity for wealthy investors. We're talking to every fund manager out there, all of whom have interest in pursuing a product that includes private markets, Cahill says. Private equity involves a different set of risks than do stocks and bonds. For one, it's an opaque, illiquid world. Private equity firms frequently invest in companies that are too small or risky to issue publicly traded shares. Those businesses don't necessarily issue quarterly earnings reports, and their values can be murky. Similar dynamics apply to private credit, real estate, and other private assets, often referred to under the broad private equity umbrella. Moreover, private funds typically lock up investors' money for years, only periodically valuing their holdings or giving investors a chance to cash out. That's made them ill-suited for retail investors relative to mutual funds and exchange-traded funds, which offer daily pricing and liquidity. Given the illiquid nature of private equity, it's unlikely you'd see a standalone private equity fund on your 401k menu. The investments are likely to be mingled in a target date fund or a CIT. Whether you should own private equity is another matter. Institutional pension funds and university endowments have long held private equity, credit, and other illiquid assets, betting that they'll offer uncorrelated and superior returns to stocks and bonds. Private equity firms say their track record speaks for itself. Apollo, for one, says its flagship private equity funds have returned an annualized 39% on a gross basis and 24% net of fees since inception. Even after a steep haircut for fees, that would trounce the roughly 10% average annual return in publicly listed equities. According to some private equity industry research, if 401k savers shifted 10% of their stock and bond holdings to private equity and real estate, they could boost retirement incomes by $200 a month. But studies from Morningstar and the Center for Retirement Research at Boston College have found mixed to negative results. A 2024 Boston College study found that long-term returns for pension funds, which own alternatives, was almost identical to a simple 60-40 portfolio of stocks and bonds. I think it introduces unnecessary risk, says Alicia Monell, an economist and founder of the Center for Retirement Research. People should not invest in stuff they don't understand, and I think private equity is pretty hard to understand. Investors face similar challenges to picking a winning mutual fund. Buying or selling at the wrong time, along with high fees, can sharply erode performance, says Hal Ratner, head of research at Morningstar Investment Management. Attractive industry returns may also be skewed by a few standout funds. One private equity benchmark beat the S&P 500 index in 22 out of 23 years from 1998 to 2020, according to Morningstar. But that was driven by a few stellar funds, much like tech stocks such as Nvidia have driven stock market returns. There's a lot of focus on superb private equity funds, but they're in the minority, said study co-author Leah Mitchell. Another hurdle today is steep asset prices, pushing deal multiples close to record levels in North America and Europe, according to a recent Bain & Company report. Deal multiples are averaging 12 times enterprise value relative to operating earnings. That's up from 5 to 10 times in the early 2000s. Higher prices could mean less upside when firms try to unload their assets, denting the total returns. And then there are the fees. It's unclear what 401k investors would pay. But a look at interval funds isn't encouraging. The average interval fund has an expense ratio of 2.5%, according to Morningstar. That's almost 10 times higher than the 0.3% average for target date funds holding mainly stocks and bonds. Even if investors were willing to pay up, an increase in fees could elicit class action lawsuits. A spate of such suits, targeting high-profile companies like Caterpillar and Lockheed Martin, has helped wring excess fees from 401ks, but it also put a chill in plans offering higher fee funds. Some lawyers are ready to pounce. I believe in my heart of hearts private equity is inappropriate for 401k investors, said retirement class action lawyer Paul Secunda. I'll sue in a second. There's another way to put private equity in your portfolio. Open your retirement plan's brokerage window if one's available, and buy stock of firms like KKR, Apollo, which oversee private equity, credit, and other types of alternatives. The industry's returns have been solid, and firms are raising billions for new funds that will generate fees for years. That may reward investors in their own equity without having to go private. And with that, we've come to the end of our reading of Barron's Magazine for March 10th of 2025. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost recently. Bye for now.